one of the side effects of this much weaker yen has been to propel the Nikkei much higher as well. Very appealing for foreign investors. It's not really helping out at the moment, though. We've got the Nikkei off by 0.75%. And if we take a look at Asian stocks valuations, I mean, notwithstanding the big rally we've seen in Japan, stocks there still looking reasonably cheap. Are you tempted at these levels?
Absolutely. So Japanese equities is one of our key overweight calls. And you rightly pointed out that Japanese stocks are cheaper versus not only global stocks, but also US equities. So from a valuation perspective, there's a good argument to be made. But let's not forget that we had the recent reforms from Tokyo Stock Exchange. And we think that corporate buybacks will progressively increase for Japanese corporates, given that they are so cash rich. So that should be another tailwind for Japanese equities. And I mean, Japanese growth, Japanese manufacturing PMI has been quite resilient. So we see that there is room for further upside in earnings revisions over the next few months. So overall, we think the recent pullback in Japanese equities may not be a bad opportunity to add exposure, especially for international investors who can potentially benefit from yen strength over the next 6 to 12 months as well.
Do you add exposure to China given the yuan's weakness as well?
Well, we are neutral on China right now. So, I mean, there are some fairly convincing drivers which argue for China, right? Valuations are quite cheap. Analyst expectations for earnings growth is still quite elevated. But we've seen, persistent outflows. We've seen the uncertainty out there in terms of when will China's growth momentum stabilize. So I think the data that we get from Golden Week in terms of consumer spending will actually be quite crucial. So right now we think it makes sense to stay neutral on China. But yeah, we are looking out for opportunities to trigger and add exposure to China once we see a turnaround in economic data.
And what are the opportunities as we continue to see this global bond rout as well?
Well, from our perspective, the recent rout is looking quite stretched, and it actually is a great opportunity to add to long duration bonds. So we are overweight on developed market government bonds as well as EM local currency bonds. From our perspective, we think that 10-year Treasury yields could come down towards 3.25 to 3.5% over the next 12-month horizon. So you can lock in the attractive yields, but also position yourself for capital gains on a 12 to 18-month horizon.
In terms of the higher for longer narrative that we keep discussing on the longer side, I understand you've put a date on it, September. That's when you expect to see the Fed begin cutting rates. What sort of state will the economy be in by then to demand that sort of move?
Well, we expect the Fed to start cutting rates maybe slightly earlier, around Q2 next year, but cut rates towards 4.75% by September next year. Now, from our perspective, we think that markets are, at the risk of being complacent. Recession has probably been priced out to a large degree by both equity as well as bond markets. But let's not forget, right? Businesses, corporates, households have had 15 years of close to 0% borrowing costs, and it would be a significant surprise if we see the recent rally in bond yields not having a victim, both from a financial system perspective, but also from a broader economic perspective. So we think, the faster bond yields rise, there's a probability that they'll fall faster as well over the next 12 months.
So ahead of that, which team are you on? Team soft landing or team recession?
Well, we are on team recession. We have around 55 to 60% probability of recession in 2024. And see, I mean, we've started seeing inflation coming down, so that at the margin should allow Fed to cut rates next year. But we think that, the fact that the student loan repayments have started will also start crimping the consumer sector in US, which has been the source of strength. So we think the recession could start in Q2, Q3 next year, but it's likely to be a mild one. So, we think that a diversified allocation right now makes sense. But yes, we do like long duration government bonds at the moment, especially given the rise in yields we've seen.